It's still saying a few moments, so hopefully it'll pop up. Hi everyone, I think I'm looking on YouTube to see if we are live. Just going to give it a couple more seconds to just, I think there might be a slight delay from where we're sitting, so bear with us for a couple of seconds while we go live, and then we'll kick in. Hope everyone has a beer or wine, apart from us apparently, we're both on water.
Water.
Okay, I am seeing that we are live, but I am seeing not. Let me just have a quick check.
Maybe someone could comment on the.
Yeah, is there a commenter? I also have people tuning up at my house, which is great timing. Oh, here we go. I think it looks like we're on. Great. Excellent. Okay, well, thanks everyone for joining. Welcome. Nice to see there's a few comments starting. So, yeah, I think this is going to be a big turnout tonight, which is pretty cool. And I think even cooler is that ETFs as a word is probably, I don't know, in my opinion, one of the worst uses of jargon ever. But they are a very popular way for savvy investors to put their money to work. So I'm really stoked to see so many people, well, we all are, have kind of come along to find out a bit more about them. And oh, I'm seeing a lot of we're here waiting, and we're all good, loud and clear, great. So tonight, in the cheesiest of ways, we're hoping to highlight the fun behind funds. And I think we sent out some pre-reading for this one, so everyone should be across the basics of what an ETF is. But I know Andrew, who is going to start with a bit of a short summary anyway. And this should be an interactive evening. We really want everyone to participate. So please grab your wine, coffee, beer, water, milk, whatever it is, and settle in. Both of us are on water, tragically, and we will try and run bang on an hour. So the next hour will go like this. Andrew's going to talk for about 30 minutes about a range of topics related to ETFs. You should be madly writing questions in the comments, as a few people are already doing, as he goes, because the last 30 minutes is going to be a Q&A on all things ETFs. We've got some pre-questions from a bunch of you, and we've got a couple that we've put together from various channels in different places where people have gotten in touch, and we will try and get to them all. At bang on 7 o'clock, we'll finish up. And then in the next couple of days, we're going to send out a bit of a survey to get your honest feedback and suggestions for the next webinar. And again, don't be shy. We are very, very fortunate to have access to people like Andrew. So I'm very, very happy to bring them to you. So yes, first up, a big thanks to our Aussie friend Andrew for coming along tonight. A few of us met up with Andrew when we were in Sydney last year before the global meltdown. And very, very weirdly, we got excited about synthetic ETFs over a coffee. So a little bit about Andrew. He's the Vice President for Passive Distribution at DWS Group. I've been practicing saying that today. And DWS Group may be a new name to many people watching, but basically they're just like Vanguard and BlackRock. The difference between DWS and Vanguard and BlackRock is that they're based in Europe. And also, fun fact, they are leaders in ethical investing and swap ETFs, which Andrew will cover. A very interesting fact as well, DWS is in fact one of the world's largest fund managers with about $1.2 trillion in money under management. The company's 60 years old and headquartered in Germany. X-Trackers is DWS's ETF brand, and they are the largest European-based ETF issuer. Is that correct, Andrew?
You got it right, yeah.
Great. And just to probably make it very awkward for you, I'll do a bit of a intro on what your job is, which is basically to make X-Tracker ETFs available to customers across New Zealand and Australia. So we got a little bit of a bio, but I fiddled it around a bit. But basically it's that Andrew helps people design their portfolios deciding what mix of stocks, bonds, and other investments will work for them. But he also spends a lot of time educating people about ETFs in general. And he's been in finance for over 15 years, which is a lot longer than me. Kristen, myself, and Jared from Hatch are celebrating our 3-year Hatch anniversaries on Sunday. So we are about 12 years behind you, Andrew. But yeah, suffice to say, he knows his stuff. So just before Andrew kicks in, I've got a few bits about rules and stuff, and then I will be straight over to you, Andrew. So basically, a little bit about ETFs. Until Hatch, Kiwis really only had access to a handful, and they often invest 100% of your money into another fund. One of the most common is the US 500 fund that invests directly into the Vanguard S&P 500 fund. So not only has our selection been quite limited, they've been expensive, and they've probably resulted in all of us being a little bit behind where the industry has moved. So it's pretty cool to have someone who lives and breathes ETFs here, hopefully busting some outdated information and introducing us to some of the innovative things happening in the industry. For those of you who don't know, Hatch has over 900 ETFs listed. Currently, there are 3 managed by X-Trackers, which we may or may not talk about if people have any questions. If you want to search for them, make sure you search for X-Trackers. We will fire our dev team. The search is not working for that. 900 ETFs is a lot. But with everything, when it comes to investing, you can make it complicated or you can make it straightforward. And hopefully tonight will help make things a little bit more straightforward. There's a lot of ways to do it, but there is no one way to do it. And we know there are several Hatch investors who've embraced inverse ETFs to bet against the markets. Others have invested in different industries and countries, and some like to select a couple, like 2 or 3 that cover the global share markets and maybe some bonds. So they can set and forget the investing. So there's a whole bunch of different ways, and we will learn about a few of them tonight. 3 rules of engagement: ask questions. Seriously, there's a comments field. Please ask, because my job is to just monitor and be your voice here. If you don't ask, I'll ask my own questions, which will probably all be about synthetic ETFs. But our goal is that everyone learns something tonight. And secondly, please don't take anything we say as financial advice. This is two people sharing information to uncover some interesting corners of the ETF world. The only non-advice we'll ever give you is to do your own research and don't just take what we say. And third is shout out. Andrew and I just spoke about this. If you spot any jargon, this industry thrives on it. And one thing we've learned is you actually don't need to know it to understand the concept. So if you don't understand, let us know in the comments. You won't be the only one wondering, but you will be a hero for asking the question. Now over to you, Andrew.
Thanks, Nat, and hi to all the Hatch investors, and thank you so much for having me here today. It's a pleasure to be here. So I thought today we'd just run through a bit of a crash course on ETFs. We'll have a bit of basic information, and we'll also go into some maybe intermediate information. Have a look at what exactly is an ETF, what are the different types of ETFs, because there's quite a few out there at the moment. What are the general benefits and risks of investing in ETFs? We'll have a look at some of the differences in markets and where ETFs are domiciled, such as Europe, the US, and in APAC as well. Now, there's a bit of a hype now around ethical investing or ESG investing, so we'll take a look at that. And we'll also showcase one of the most popular China indices. So Nat, if we go to the next page, please. So we'll start off with what is an ETF. So an ETF is an exchange traded fund. It's a fund which is listed on the exchange. So it's almost like you could use the saying, buying a single stock is like finding a needle in a haystack. Instead, why don't you just buy the whole haystack? So with a stock, you're constantly searching for that solo winner. Across all these different stocks across the globe. There's thousands and thousands and thousands to choose from. Or an ETF, which actually holds a basket of shares within it. So essentially, an ETF is a basket of shares that can be sold on the stock exchange during market hours in one simple trade. So the underlying basket is generally shares or equities, but it can be fixed income and bonds, and we'll also discuss some commodity style ETFs as well today. So an ETF generally tracks or replicates an index. So what is an index? One of the most popular ones you've probably heard of is the S&P 500 or the New Zealand 50 or the ASX 200. Basically, these are hypothetical baskets of shares. If you were to invest in an ETF, in an index, you'd have to do, if you wanted the S&P 500, you would have to do 500 different trades. That'll be quite costly. Or you could just buy one share in an S&P 500 ETF. So each ETF has a unique code and unique ticker on the stock exchange, just like a regular stock. So the key benefits of an ETF is they offer targeted exposure to different countries, regions, sectors, or asset classes. There's actually quite a few out there on the market now to choose from. So how exactly do ETFs work? So basically, if the value of the underlying basket of securities rises, then the share price of the ETF rises. So they're aligned all the time. If the value of the basket of shares within the ETF drops, then the value of your ETF share price drops, and they always stay the same. How do they stay the same? It's because we actually appoint a range of different contractual market makers to ensure that the share price of the ETF always hovers exactly where it needs to be. So just a bit of history on ETFs. They're actually not new. They've actually been around for approximately 30 years. The first one was listed on the Toronto Stock Exchange back in 1990. And as of January 2020, there was over 7,000 ETFs listed across the globe. And there's around about, if you're talking US dollars, around about 6.3 trillion US dollars in ETF assets under management. So the industry is absolutely booming. And this is what we call passive style investing. So you've probably heard of active or passive investing. ETFs are generally passive in nature because all they do is just buy and hold all the shares in a chosen index. That's all they do. They're nice and simple. They buy and hold those shares. Versus active management, which is generally what a lot of fund managers try to do, is they try to outperform the market, and they're generally a lot more expensive because you're paying for their science, basically, to beat the market. But with an ETF, if you look at the most simplest form of ETFs, you'll generally get the market return. But with active, you'll get, hopefully, above market returns if the fund manager's good enough. We'll go to the next slide, please, Nat. So I've got 6 benefits here of exchange-traded funds. So you can see here on the picture, the left-hand side, the girl's quite happy, so she's getting a range of benefits. Now there's a range of risks as well, highlighted by the young child there on the right-hand side. So firstly, ETFs are generally low cost. I think the cheapest ETF in the world, according to Bloomberg, is around about 0.03% per annum, or 3 basis points. That's absolutely crazy. ETFs, generally we say, probably, if you look at a more expensive style ETF, probably around about 50 basis points on the New Zealand Stock Exchange or so for an emerging markets exposure, or 0.5%. And the reason why ETFs are so low cost is because it's a very simple strategy. They buy and hold the basket of shares in the chosen index. Also, costs have been coming down over time with ETFs because the industry is evolving so quickly. And we'll go into that further in a later section of this presentation. The second benefit of an ETF is small minimum capital requirements. So with an ETF, you can invest with as little as 1 share. So sometimes the prices of an ETF can vary, but you can get some for, let's just say, $4 on the stock exchange, up to hundreds of dollars, really. But you won't need to outlay an initial amount of $10,000 or $25,000, such as some of the other unlisted managed funds out there. The third benefit is diversification. So in one trade, you get a fully diversified portfolio, which is great. Some of the ETFs out there, such as a world exposure, let's just say an MSCI world exposure, in one trade, you will get up to, I think it's 3,500 stocks or so, split across 23 developed countries in one trade. The fourth benefit of an ETF is that it is exchange traded. So that means you can enter and exit a position of an ETF during market hours at any time that suits you. So if something goes wrong in the market, or you're getting a little bit worried, or you want to add a bit more money to your investment during market hours, you're welcome to do so, as long as the market's open, really. Versus some unlisted managed funds style investments where you can only invest once a day during, I think there's once a day that they do pooling, or maybe once every 2 weeks or so that they do pooling for a managed fund. Probably the last benefit of, actually second last, is targeted access. So with an ETF, if you want to invest into China, there's a China ETF for you. If you want to invest in Bangladesh, India, Pakistan, Taiwan, the US, or a broad exposure, or fixed income, or tech, or something, I guarantee you there's pretty much an ETF out there to suit you. So you can be really targeted on where you want to invest into. Last benefit is ETFs are fully transparent. So unlike a managed fund where they don't disclose the full underlying holdings of the fund, an ETF always publishes the underlying holdings on a daily basis. So if you invest into an ETF, simply go to the ETF issuer's website, click on the Excel file, and an Excel file will pop up and it'll show you exactly what shares or assets the ETF holds. That's published every single day. So ETFs are extremely transparent. Now, if we go on to risks, just quickly. So with every investment product, there's always risks. So it's just important to highlight some of the risks of ETFs. Firstly, and we'll go through some that are similar to stocks as well. So first is market risk. So there's a risk that your initial amount of capital invested may decrease. That's similar to a stock as well. If you buy stocks and the market goes down, there's a chance that your market will go, your share price will go down as well. Liquidity risks, that's the risk that the ETF can't be bought or sold quickly enough or to present a loss of capital. So that's similar to an ordinary stock investment as well. Tax risk, so if you invest into ETFs that have, let's just say, US underlying or some emerging market underlying, there may be some taxation benefits such as withholding taxes or local currency taxes, etc. as well. Tracking error, so that's always a good way to judge an ETF's performance, is how does an ETF's performance track against its chosen index? Ideally, you want the index and the ETF to be closely aligned. That shows that the portfolio manager is doing their job and they're giving you the index returns. But some ETFs have a little bit of trouble doing that, and they can actually have a bit of tracking error. So, for example, the index could produce 1% over the last 1 month, but the ETF may only produce 0.9%. So there's a 10 basis point tracking difference there. So ideally, you want them to be aligned. Not capital protected as well. So that's another risk, is that ETFs are not capital protected. You have the there's a probability that you lose the initial amount that you've invested, which is similar to an ordinary stock as well. And counterparty risk. So if the ETF participates in stock lending, i.e. the ETF holds a basket of shares, if they actually lend that out to get a bit of extra return for investors, that can present a bit of extra counterparty risk for an investor as well. So the key message here is always know what you're investing into. Please do your due diligence, read through the product disclosure statement, and fully understand what you're investing into. Okay, now if we go to the next slide. So now we'll discuss different types of ETFs. So as I mentioned, ETFs have been around for around about 30 years. And now there's a lot of different styles of ETFs and structures of ETFs out there, particularly in the US as well, which Hatch gives investors access to. So there's 4 types of ETF structures that we're going to go over right now. So the firstly is a physical ETF. The second one is a synthetic ETF. The third one is an ETC, or an exchange traded commodity, which are quite popular these days. And the fourth one is an active ETF. So we'll start off with a physical ETF. So a physical ETF is probably the most simplest form of an ETF, and it's the most common. The majority of assets around the world, according to the latest EFTGI report, December 2019, shows that the majority is in physical replicated ETFs. So a physical-based ETF is simply an ETF that physically buys the underlying shares of an index. So, for example, an S&P 500 exposure, a physical ETF would physically buy those top 500 stocks on that index and put that into the ETF. It's as simple as that, really. So the second type of ETF is a synthetic ETF, sometimes known as a swap ETF or a quite exotic style ETF. So essentially, synthetic ETFs use a type of replication method known as financial engineering to achieve index returns. And generally, synthetic ETFs are more exotic in nature and a little bit more risky in nature. So basically, synthetic ETFs use complicated ways and underlying institutional products to achieve index returns. They don't actually have to hold the exact same stocks per the index that the ETF is trying to track. So for example, a S&P 500 synthetic ETF doesn't actually have to hold the S&P 500 stocks as underlying. They can hold a completely different basket of securities as underlying, but any difference between that basket of securities and the index can be made up by a swap contract or a futures contract or a net total return flexible notional swap contract. They get quite complicated, let's put it that way. There are some benefits of investing in a synthetic ETF. So the first one is access to difficult markets. So there's some regions around the world where it's quite hard and inefficient to buy physical securities. So it may be more efficient to do it via a swap structure or a derivative contract. Some areas that I could name, Pakistan, India, Bangladesh, Vietnam, there's a lot of swap-based products or synthetic-based ETFs which cover these regions because sometimes it can be more efficient. Another benefit of synthetic ETFs is sometimes you can potentially get extra returns. So if they use a swap contract as underlying, potentially they can pass on some swap spread back to the end investor, which can sometimes actually offset the whole annual ETF cost. Obviously, any ETF issuer is different. So please do read how the product is structured and please fully understand it before you invest into these styles of products. Another benefit of a synthetic ETF is potential tax efficiency. There's some governments around the world that have classified swap products or synthetic products as exempt from taxes. Obviously, we at DWS don't provide tax advice, so please seek tax guidance if that is an angle that you want to invest into a synthetic ETF for. But generally, a synthetic ETF is higher risk. They don't always hold the exact same stocks as the index. They can have counterparties involved, particularly if they're using swap contracts as underlying. And they can have collateral risk as well. So if there's any amount owing by a counterparty, hopefully that risk is collateralized, but there is collateral risk as well for synthetic style products. I believe from recollection on the EFTGI report, December 2019, in the US, approximately 10% of all assets under management are in synthetic-based products. 90% is in physical products. In Europe, I think, if I recall correctly, it was 28% was based in synthetic products and the rest was in physical-based products. So a synthetic ETF operates quite the same in terms of trading style as a physical ETF. You can have intraday trading. You can trade during market hours, low minimum investment size of just one share. And they're generally fully transparent as well, but generally a little bit more risky. So please try and understand the product that you're trying to invest in, or call the ETF issuer and ask them for more information so you're comfortable with with the product that you're investing in. The other product we're going to mention is an exchange traded commodity, or an ETC. So these have been extremely popular over the recent pandemic period. A lot of global flows, according to Bloomberg, were allocated to gold-style products or commodity-style products, because commodities have shown in the past that they can be a good hedge against market volatility. So an ETC, or an exchange-traded commodity, gives you access to physical commodities in an indirect way. So they're listed on the stock exchange just like an ordinary ETF. So they have their own ticker or stock code, and they have a share price as well. And that share price is linked to the spot price of the relevant commodity. So let's use the most popular one, physical gold. So a lot of people are investing into physical gold lately. So the share price of a physical gold ETC will relate directly to the spot price of gold. Now, new units of an ETC can only be created and sold to an investor once an armored vehicle has delivered physical gold bars to a vault, and the custodian of that vault has signed off on that delivery. And then once that signature has been achieved and the gold is securely in the vault, then new ETC units can be created and sold to investors on the stock exchange. And it's vice versa as well. So if people want to sell their units, if enough people sell their units, then they'll take gold out of the vault. So it all nets out, basically. So your units in an ETC are fully collateralized by physical gold bars in a vault, or physical commodities in a vault. So as an investor, you really have two options. If you want to invest in gold, you can go down the street and you can go to your local gold dealer and order a pallet of gold, get them to ship it to your warehouse, and then you've got to pay for warehousing costs. Or you could buy units in an ETC online, which is an indirect way. And those units of that ETC are directly linked to a physical gold bar in a vault. It's generally, I'll use one example, JP Morgan vaults in London. So by using an ETC, you get indirect access to a physical commodity without actually having to take physical delivery and warehouse it yourself. So they're simple. ETCs are simple. They're secured as well, because all the metals are stored in secured vaults. They're liquid as well, because they are bought and sold just like an ordinary share on the stock exchange. So if you don't want it, you just put in a sell order online. Spot return as well. So your share price of the ETC is directly linked to the spot price of the relevant commodity. So if gold price goes up, your gold ETC will go up as well, and it will be aligned. And also sustainable sourcing. So a lot of these commodities are sourced sustainably these days. So we look at the whole real value chain and ensure that all the commodities meet, for example, the London Bullion Metal Association responsible sourcing guideline, just to ensure that everything's sourced sustainably. The last type of ETF that I'll mention quickly, and I'll have to run through this actually, I think I'm taking too much time, is an active ETF. That's sort of like an active managed fund, but it's actually listed on the stock exchange. So they're generally trying to outperform the market. They're generally a little bit more expensive as well. And I'll probably put like an inverse ETF or a double leveraged ETF in this active category, because they use complicated financial products such as futures and options to hedge risk as underlying. And they're generally more expensive as well. It's more of an active strategy versus a passive ETF, which simply just buys and holds stocks. So I hope that gave you a good idea of the 4 different real styles of ETFs available. So we've got physically replicated ETFs, we've got synthetic replicated ETFs, we've got exchange traded commodities, and we've got active ETFs. So now we might go to the next slide. Thank you. So this next slide, so just a little quick update on the global ETF market. So the US market, according to the latest ETF GI report, December 2019, shows that the US ETF market has $4.5 trillion in ETF assets under management. Europe has $1 trillion in assets under management. Australia and New Zealand combined have around about 65 billion Australian dollars in assets under management. So the key point I'm trying to make here is the Australian and New Zealand ETF market is extremely small compared to the other markets around the globe. According to Bloomberg, as of today, I just did a check on Bloomberg. So you can actually buy an S&P 500 ETF listed in the US for 3 basis points, or for 0.03% per annum. So it's extremely cheap. Or you could buy one on the New Zealand Stock Exchange for 0.34%. So why is the difference there? Well, it's because the US market is so much larger, the ETFs are so much bigger, and generally we find that ETF issuers reduce the fees of the ETF as the AUM, or the assets under management, increases. So because the ETFs overseas are so much more larger and liquid, they're generally a lot cheaper as well. Another good example is in the US, you could buy an emerging markets ETF for 11 basis points, or 0.11% per annum. Or if you want to buy this same kind of exposure on the New Zealand Stock Exchange, you would have to pay 0.59% per annum. So I guess this is one of the benefits for being a Hatch investor, that Hatch gives you access to trade in the world's largest ETF market, which is the US. So generally, the products, as a rule of thumb, generally the products are a lot more cheaper, they're a lot more larger, and they're a lot more liquid than to other parts of the world. Now, if we go to the next slide, please. So we'll talk about now ESG investing. So what is ESG? So ESG is environmental, social, and governance investing, sometimes otherwise known as socially responsible investing, or responsible investing. So essentially, ESG investing is all the rage across the world now. Why is this? Well, firstly, it's because governments are introducing legislation to get rid of, companies that have high carbon footprints or high fossil fuel emitters. So essentially, and also because of millennials, the millennials that are coming up these days want to take charge of making the world a better place in the future, and they will not invest into controversial activities. So ESG investing means investing ethically and avoiding companies that operate in controversial areas or activities. So examples of controversial areas or activities is, let's just say, gambling, tobacco, alcohol, or carbon or fossil fuel emitters. So I guess academia has shown that if you do invest ethically, there's a pretty good chance, or at least historically, according to the latest MSCI study on ESG investing, that ESG investing can actually deliver outperformance versus non-ESG investing as well. And there's some great reports out there if you want to just do a Google search on analysis on ESG investing. As an example, the S&P 500 index year to date has produced 3.49%, according to Bloomberg, which I checked today. But the ESG version of that, the S&P 500 ESG index year to date, has performed by 5.52%. So ESG investing is essentially taking a normal basket of stocks and removing those companies that have that are engaged in controversial activities or are high carbon or fossil fuel emitters. So I'll probably leave you with a question, and the question is: would you would you be comfortable achieving very high returns in your portfolio if you knew that the companies that you were investing into were causing the most damage in terms of climate change, or were the largest producers of tobacco, or the largest distributors of alcohol? So I guess that's a moral question, but now we are seeing a lot of shareholders and governments around the world demanding ESG investment. So I think that's actually the future of investing. And historically, what we've seen is that ESG investing, or if you've decided to have a basket of shares but remove those bad stocks, basically, has actually delivered outperformance as well. So yeah, please do some research on ESG investing. It's actually quite interesting. We'll go to the next slide, please, Nat. So this is probably the last slide, and I think I'm coming up to my time limit now. So we'll talk a little bit on China. So China has been one of the most popular inflows regions in ETFs over the last 6 months, according to Bloomberg. As of I think it was yesterday that I had a look at Bloomberg flows. So I did a simple comparison today, and if you have a look at different types of ETFs around the globe, different kinds of exposures, China has actually performed quite well, and it's shown resilience through the latest pandemic. So I compared the China CSI 300 index, which is one of the most popular China baskets of shares to invest into China. I compared the S&P 500 index, MSCI World, which is a broad-based world exposure, MSCI Emerging Markets, ASX 200, and also MSCI Europe. So 6 different regional indexes. And the outcome of that was that the China CSI 300 index year to date has performed by 18% year to date. The next best performing country was the US with the S&P 500, which has actually performed year to date 3%. So that's the next best performing region out of that sample that I did today. The worst one was Europe, MSCI Europe Index, which performed by negative 7.6% year to date. So I quite like this term. Isn't it quite ironic that China was the epicenter of the pandemic, but out of this basket of shares, which has the major regions around the world, it's actually performed the best. So China shows quite good resilience, as we've seen in the performance year to date and of previous years as well. So I thought I'd feature the China CSI 300 index, which contains the top and the largest 300 shares across the Shanghai and the Shenzhen stock exchanges in mainland China. So if you are thinking about investing into China due to the high GDP rates, the resilience to market turmoil, then perhaps take a look at the China CSI 300 index. If we have a look at the sector breakdown of the China CSI 300 index, there's around about 32% in the energy sector, 11% in materials sector. Then we've got just consumer discretionary and consumer staples, both at 11 and 9.6% each. So there's a very diverse. And then it goes to healthcare, financials, information technology, telecoms, and utility. So it's a very diversified portfolio of mainland China stocks, and potentially something to think about if you are thinking about investing into China in due course. So I think that's about it from me. Those are the main topics I wanted to cover. Now, if you've got any questions, feel free to jump in. If I've explained anything wrong, let me know, and I can have to explain it now, or I can take any questions. It's totally up to you.
No, I'm back, and I've been madly kind of writing stuff as I've seen the questions coming through. So I'm hoping I've got a reasonably good order of questions. Firstly, thank you. That was imagining gold going into a lock safe was a very cool thing to imagine.
Yeah.
So I think we'll start with that. So we had quite a few questions about the ETF types, and I wanted to do the really cool thing where we put them up on the screen, but there's a few of each one, so I've just grouped them.
Sure.
So one of the kind of groupings was, how do we tell the difference between the 4 types? Like, how would I tell when I'm browsing around and looking at all the different options available?
Yep. So if you see something that appeals to you, go to that ETF website on the ETF issuer's website. So just click on the stock code and it will actually say replication type. So if you are going to invest in an ETF, always browse to the ETF issuer's website, click on more information about that ETF, and it will actually say replication method. It'll say it'll say physically replicated, synthetic replicated, exchange traded commodity, or it's an active managed, an active ETF or something like that. But definitely, yeah. So everything must be disclosed by the ETF issuer on their website.
Yeah, no, and I think that's actually an important thing that people don't necessarily know is that most stuff that's traded on exchanges, they have that level of transparency that you talked about that is a much higher than what we might expect. So it is always, and most of those sites are starting to get a lot better with the information they give. I'm not going to ask you for examples of each because now you've told us that. I think that will be a challenge.
With the gold one, actually.
What's that? Oh, the gold one?
Yeah, with a physical gold ETC, exchange traded commodity, you can actually go onto the ETC issuer's website and they actually publish a list of all the gold bars that they've got in the vault with all the serial numbers on those bars as well. So that's the level of detail that is disclosed to an ETC investor these days. They don't just say we've got 20 tons of gold in a vault. They'll give you the serial numbers. They'll give you the weight as well of each of those gold bars. Everything's downloadable in a spreadsheet on a daily basis.
Have you ever been into one of those vaults? That's my own question.
Right. I love it. Indeed.
Another question, is water an ETC?
Not at this stage, no. I personally have never seen a water ETC. I believe there are ETFs out there, just general ETFs, that invest into shares of companies which are improved water, basically.
I think we actually do have a few on Hatch, actually. But yes, so water itself is not stored in a vault.
Correct. Correct. You can get ETCs. Also, you can get, let's just say, a crude oil ETC that actually has physical gold bars in a vault as collateral, really. So it doesn't have to always match. The main point is if that crude oil ETC, the spot price or the price of the ETC is based on the spot price of crude oil, but they're just fully collateralized by physical commodities in a vault. So it doesn't really matter.
To catch you up, someone did ask what collateralized. They said collateralized ? What's a quick explanation of the word?
Yeah. So basically, if you buy an ETC, there's a debt between the ETC issuer and the investor. Basically, the ETC issuer owes the investor the price of the spot price of gold, basically. But if that debt, if for some reason the ETC issuer goes insolvent, then they've got a full vault of physical gold bars in a vault, which are held on a custodian, which they can sell and refund investors. So basically, if the middleman goes bust, you've got recourse to get your money back.
Very cool. I'm going to come back to some more of those questions because I'm aware we've only got about 17 minutes left, and that was largely my fault trying to figure out how to get the video going. We had a few questions about volatile markets. So there was a couple in that. How do ETFs perform in volatile markets? Someone else asked, is there an ETF bubble? And then someone else asked if they seem to be less volatile than investing in individual companies. Is that true? And do you expect it to stay that way?
Okay, so first question, how did ETFs perform in volatile markets? Generally, they went very well. So the main point of an ETF is to provide liquidity to investors. Let's just take a look at fixed income ETFs as an example. So there's a lot of illiquid style bonds out there, such as emerging markets bonds or high yield corporate bonds in the US. They're generally hard to price, those bonds. But ETFs provide that second layer of price discovery. So during the recent pandemic, we've seen a lot of the underlying bonds in an ETF being unable to be priced. So, but we also saw that the ETF share price of those bonds always was active, and it was always able to provide liquidity to investors to get out. What we did see in recent periods of volatility was that ETFs, sometimes if the market makers are having trouble pricing the underlying instruments or the underlying basket of shares or bonds, then they've got to hedge out that risk by increasing the buy and sell spread. So my key message is, during periods of volatility, and what we observed recently was that ETFs still performed well during the recent pandemic. The main difference is that their buy and sell spreads widened out a bit. So market makers could hedge not being able to price the underlying assets, really. So it cost a little bit more to enter and exit positions, but you were still able to enter and exit positions.
And I suppose on that note, we did have a question about mutual funds and how there seems to be some thinking that it's easier to sell back to a fund manager versus ETFs, where you are kind of reliant on that marketplace that you've just talked about. What's your feeling on that, the benefits and downsides, I suppose, to ETFs from the buying and selling point of view?
Yep. So with an ETF, firstly, it's exchange traded. So generally, you can trade against other people in the stock market. ETFs are open-ended, which means that market makers, we generally have about 2 contractual market makers per single ETF.
Can you go a little bit into what that means for my sake, if no one else's?
So let's just say I'm an investor. I need to buy shares off someone. Let's just say you don't have any shares to sell me. There'll be a company called a market maker who an ETF issuer contractually gets them to lock into making markets. They are contractually required to buy and sell shares to provide liquidity to investors. So these guys sit on the sidelines, basically, and they have the ability to create new ETF units to sell to investors, or they can buy new units from buy existing units from investors to take back. So I'll probably say to the person who asked the question, if you do not see enough liquidity for an ETF, never judge the liquidity that you see on the screen, because an ETF follows a very unique mechanics. It's called the unique creation and redemption process. So basically, if you can't see enough buyers for your sell, all you'd have to do is call up the ETF issuer, and they'll get one of these market makers to buy that back off you very easily. So the ETF issuer will actually buy those shares back, and then they'll actually get rid of those shares, so they'll no longer exist. So that's the unique creation and redemption process. It's probably a little bit outside of the scope of today's discussion, but please just...
Yeah, I was going to say, I feel like one of the things that we've kind of stuck to a lot is having those really large ETFs that just have that liquidity. There's just a lot of people investing in them. So it kind of, that to me feels like quite an edge case. But fundamentally what we're saying is you're not stuck. You're very unlikely / it's impossible to ever be share.
So, the main message I want to get across is an ETF is not a stock. An ETF is an ETF. And an ETF has a very unique background and mechanics in place to ensure that there's actually 2 layers of liquidity. You've got your secondary market liquidity, i.e. what you can see on the screen, and you've actually got a thing called a primary market liquidity. So if you can't sell it on the secondary market, or if you can't buy it on the secondary market or the stock market, just call up your ETF issuer. They'll get someone to buy it off you straight away. They'll get one of these market makers to fulfill your order, no matter what size it is. So please don't think of an ETF as a stock. They're structured completely different. And this mechanics of an ETF have been around for 30 years, and it's proved to be very good indeed. If you do want to find out a bit more information about that, you can always go on Google and just go how does the creation and redemption mechanism work? I'd probably say it's a bit intermediate in nature rather than beginner in nature. So you may get confused, but just be mindful. Please call up your ETF issuer. They will arrange for liquidity to be provided to you.
Awesome. And I feel like we've gone quite far down the kind of pretty sophisticated end. I'm going to rein it right back to a couple, one about ESG, but I'm going to start with like, we have 900, several of which are from X-Trackers. There's huge amounts of, there's 4 different types. Largely, there's all these different niches. And I think one of the things that I've seen a lot of that seems common in New Zealand, because we do only have this handful available normally, that people tend to just kind of maybe double up too much, where they kind of buy 10 ETFs that kind of have so much crossover. What's your thinking on what sort of an average person, how many ETFs should they have? Do you have any sort of rough ideas on kind of the types or how they do it for someone who just kind of wanted to keep straightforward?
Yep. So I've basically seen it all. I've seen portfolios with up to 20 ETFs, which are quite tactical in nature. And I've seen portfolios with 2 ETFs. Without looking into a client's personal circumstances, it's hard to tell how many ETFs you should hold in your portfolio, because obviously we're not here to provide financial advice today. But I tell you what, like, one segment of my clients are financial advisors, and I have noticed a bit of a theme with financial advisors and how they structure client portfolios using ETFs. And the general theme that I've seen with financial advisors is that they probably use, let's just say, 5 to 8 ETFs in their portfolio. So they would be along the lines of, let's just say, New Zealand equities, Australian equities, emerging market equities, S&P 500 or US, global fixed income, and Australia fixed income. So you can have a combination of, let's just say, equities, fixed income. You could put a bit of gold in there. If you want to take a punt on China or Bangladesh or something, you could put a little bit to the side and take an exposure of that. But one size doesn't fit all. It really depends on, do you want a core portfolio that you're going to buy and hold over the long term? Or are you more tactical in nature, and do you just want to take a short-term exposure to a certain country, region, or sector? So there's all different client types, but I'll probably recommend speaking to a financial advisor if you do that, or if you're obviously a personal investor on Hatch. It's really up to you how you want to structure your portfolio, but make sure it aligns to what your objectives are, really.
Yeah, and I think on that front, there's 2 more questions that came from that, and I completely agree. I think it's the usual. You can, if you're really interested in investing and you want to be super tactical and in it, go wild. If you want to set and forget, and you can also just as easily pick a handful. Yeah. So I had 2 questions about kind of picking. What's your feeling on the benefits or pitfalls of having an ETF that is hedged or not?
Okay, so benefits are you could gain some additional returns by hedging your ETF exposure. Cons would be extra cost. So generally, I think what I've noticed is you pay an extra 0.05% for a hedged version. For example, you could have a world for 30 basis 0.3%, or a hedged version for 0.35%, basically. So it's going to cost you a little bit more. And there's also the risk that currencies go the opposite way. So therefore, you may have best been done unhedged. So what I've seen with clients is, if you are unsure about what ways currency is going to go, let's just say you've got a New Zealand equities exposure of $5,000. Why don't you put $2,500 in the hedged version and $2,500 dollars in the unhedged version, and therefore you get the best of both worlds, and you'll kind of get a return in between the two. But the general rule of thumb is that when the Australian or New Zealand dollar rises, the basket of shares will drop. So you want to be hedged when the Aussie or New Zealand dollar currency goes up. That's a general rule of thumb. But
would you recommend doing all your hedging through ETFs, or would you have other ways to do hedging?
Yeah, there are various ways to do hedging. Obviously, today is about ETFs, so ETFs can be a very effective way to do hedging. You can also go down to your, I believe, Commonwealth Bank and those kinds of different banking institutions all have a foreign exchange desk which you can take positions on quite easily as well. I believe there's even some online currency platforms which you can go online and just show your exposure, and they can give you some hedging options as well. There's quite a few options. Yeah, indeed, yeah. But,
And then last one on this, because I realise we've only got 5 minutes left, is I'm interested to go back to the ESG side of things. We had a couple of questions. How do you know a good one? How do you know that an ETF really is environmentally, socially, governance, that they are responsible versus it's not so much greenwashing, but kind of paying lip service to the idea?
Yeah, so the one thing that we've seen is that with ESG investing, one size doesn't fit all style investors. There's so many different ESG methodologies or screening types out there that ETFs follow, but every single investor isn't going to 100% like exactly what stocks are remaining after those screens take place, because everyone has different core values, basically. So the trick is just to investigate the different kinds of ESG ETFs out there, go to the ETF issuer's website, download the fact sheet, and it will tell you exactly what types of stocks they will exclude from the parent basket of shares, basically. Then you've basically got to just sift through that, find ones that meet your core values, and then have a look at the returns as well. How has that ESG ETF performed versus if I would have just invested non-ESG? Has it outperformed or has it underperformed? If it's outperforming and it also has removed those bad controversial stocks that you don't like, how good's that? Yeah.
Yeah, bang on. I'm trying to think if there's one last question that I can ask to fill the last 3 minutes, because we've still got quite a few. And I wonder, being really cheeky, asking you while we're live, but I'm hoping that maybe we can get you back at some point to continue the discussion, because it feels like we're not quite finished. But I think there's probably nothing left. There's some big grunty questions. I suppose the easiest one to finish on is, do you have do you know, and this is just kind of off the top of your head, are there any particular ETFs or areas that you think are pretty interesting at the moment? You've mentioned China. Is there, and I think the exchange traded commodities seem wildly popular through the comments. Anything else that you think just
There's some really cool ETFs out there at the moment. If you want to invest in bourbon distilleries, there's a bourbon ETF. If you want to invest into bad stocks, so areas that are companies that do participate in those controversial areas like tobacco, weapons, alcohol, gambling, I think there's one out there called a Vice ETF. So it actually only holds the bad stuff. Marijuana ETFs and hemp ETFs are taking the world by storm now, especially in the US with the recent legalization. Biotech and healthcare ETFs, there's very niche style ones of those. Robotics and automation is a very popular one that we've been seeing lately. There's one called, I think, UFO or something that invests in style companies. You name it, there's a certain ETF out there. But where I personally have been seeing flows lately, I've seen flows into different kinds of thematics like robotics and automation, healthcare. I've seen a lot into emerging markets and China lately. There's always flows into the S&P 500 and US style exposures, and also into exchange traded commodities. In the recent pandemic, a lot of people have been quite scared and then have been parking their cash in commodities to hedge their portfolio risk. But yeah, go online. If there's a certain industry or sector or anything that you want to know if there's an ETF, just Google it. It'll probably show up because as we mentioned before, there is over 7,000 ETFs listed across the globe now. I personally think that's going to double in the next 5 years or so.
Yeah, I think like even I was doing some browsing around Hatch the other day, and we've got a millennial one listed. There's it's not just industries and economies; it's just these crazy trends. Yeah. And well, I personally love the female leadership one that only companies that invest in that. So yeah, I think that's probably a really good place to end at 7 o'clock. Thank you so much. Thanks, everyone. We had a huge audience tonight. That's awesome. And I think there's a ton of people who couldn't make it, so they'll watch later. There's a few things I have to go and look at. Exchange traded commodities, do we list them? There's a few other questions that we'll try and answer in the comments below. We'll try and convince Andrew to come back, and maybe a financial advisor at some point from the question we just got asked. But have a wonderful rest of your night, everyone, and thanks so much for tuning in.